The paper price of silver just plunged from $83 to $70.25 in hours, triggered by an overnight margin hike that forced liquidations across the board. But in Shanghai, physical silver is trading at $83.35 per ounce right now, a $7.97 premium that defies arbitrage logic because the metal simply isn't moving. Western banks hit the kill switch to crush the rally, yet inventories in China's warehouses have collapsed to 819 tons, the lowest in years, while their industrial machine vacuums up every ounce before the export gates slam shut in under 48 hours. This isn't volatility, it's a fracture exposing the system's loss of control, happening as we speak. Watch the divergence. New York's COMEX struggles to hold above $75.38 after a dead cat bounce, while Shanghai's benchmark contract closes at 18,797 yuan per kilogram, equivalent to that $83.35 spot. In a functioning global market, traders would exploit this gap, shipping metal east to west and pocketing the spread. But the flow has frozen. No shipments are crossing the Pacific because Beijing's new licensing regime, effective January 1st, 2026, restricts exports to a select few state-approved giants with massive capacities. This isn't policy tweaking. It's a deliberate resource lockdown, pulling silver inward to fuel China's high-tech dominance. The premium isn't an opportunity. It's a distress signal from buyers facing acute scarcity, outbidding the world to secure supply before the ban bites. This setup echoes the 1979 to 1980 Hunt Brothers squeeze, but inverted and amplified. Back then, U.S. speculators cornered the market, driving prices from $6 to $50 as inventories drained and deliveries faltered. Today, it's a sovereign power engineering the drain, not for profit, but for industrial survival. China's warehouses held over 3,911 tons in January 2021. Now, at 819 tons, as of December 26, 2025, we're witnessing a vertical depletion. Another chunk vanished last week alone. This isn't gradual drawdown, it's a prelude to stockout, where futures promises collide with empty vaults. The system's stability hinged on fluid global supply chains. Now, with exports curtailed, that hinge is bending toward breakage. Consider the mechanics of the Western response. The CME Group's notice, 25-393, dropped practically overnight, jacked initial margins for silver contracts by 14%, from $22,000 to $25,000. The second hike in 2 weeks. This wasn't market-driven. It was a regulatory hammer to undercapitalize leveraged longs, triggering forced sales that cascaded through $80 and $75 supports. Brokers didn't hesitate. No extra $3,000 per contract? Automatic liquidation. Stop losses hunted, paper dumped, and the price floored at $70.25. Yet, this correction failed to align realities. Physical premiums in the East held firm, revealing the kill switch as a misfire. Banks shook out weak hands, but institutions and industrials absorbed the dump, solidifying $70 as the new unbreakable floor. If you're tracking futures curves or have seen warehouse reports firsthand, how does this inventory collapse square with your observations? Write in the comments what signals you're picking up from your corner of the market. It could clarify where the next fracture point lies. The backwardation in Shanghai amplifies the alarm. Spot prices there peak at 19,400 yuan per kilogram, outpacing futures. A reversal of the usual contango, where storage costs make deferred delivery pricier. This screams distrust in future supply. Industrial buyers demand metal now, at any cost, because they sense the pipeline drying up. China's not speculating. As the world's top silver consumer, their factories, solar, electronics, EVs, face halt risks without it. We've entered physical panic mode, where paper manipulations in the West decouple from Eastern realities, eroding the market's foundational trust. Layer in the demand vortex. For 5 straight years, silver's in structural deficit, but 2025's surge stems from inelastic industrial pulls. Photovoltaics alone, the largest consumer, devoured records amid China's installation boom. Shifting to N-type cells like TOPCon and HJT boosts efficiency, but hikes silver use by 20 to 50% per watt. Even thriftier paste can't offset volume explosion. Companies will pay $100 or $150 per ounce since silver's a sliver of panel costs, yet irreplaceable. Without it, production grinds to zero. This black hole widens with electrification. EVs consume 67 to 79% more silver than combustion engines, up to 50 grams per vehicle for batteries, electronics, and charging. Global penetration accelerates, turning autos into a demand driver by 2027. Then, AI's infrastructure boom. Data centers ballooned from under 1 gigawatt in 2000 to nearly 50 gigawatts in 2025. Each server and connector locking away silver in low-resistance, non-substitutable roles. Recycling? Negligible. Most ends up entombed in tech graveyards. These aren't optional. They're the backbone of green transitions and digital economies, making silver's scarcity a choke point for progress itself. Historical mirrors sharpen the view. The 2011 silver spike to $49 exposed similar fissures. Mining output lagged demand from emerging tech, forcing premiums and squeezes. But then, supply elasticity, new mines, recycling ramps, restored balance. Now, with China hoarding its refined output, the globe's largest, elasticity evaporates. Earlier mechanics worked because borders were porous. Today's lockdown fractures that, channeling metal to state priorities while the West scrambles. Geopolitics weaves in seamlessly. Tensions in the Taiwan Strait or elsewhere typically spike safe haven bids, but a hot conflict could shatter electronics chains, slashing industrial demand overnight. Yet the baseline pull remains. Beijing's move isn't isolationist whimsy. It's safeguarding against Western decoupling efforts, ensuring their tech machine outpaces rivals. Silence from regulators and media? That's a signal too. Omission as policy, letting the divergence fester without acknowledgement, eroding confidence in the system's oversight.
For those in banking or trading, does this margin hike feel like standard risk management or something more targeted?
Share your interpretation in the comments, especially if you've seen similar plays in past rallies. It might reveal patterns in how control slips. Institutional discord underscores the instability. Goldman Sachs pegs silver at $85 to $100, dubbing it the green transition's strategic metal. Citi's bolder at $110 for H2 2026, citing immediate delivery scarcities. Contrast JP Morgan's $56 to $58, banking on slowdowns to curb demand, or Commerzbank's outlier $43 crash call, labeling it a bubble. But retail sentiment decouples. 57% of private investors surveyed expect triple digits within 12 months. This euphoria isn't froth, it's a force multiplier, as holders buy dips, stripping banks' settlement buffers. Paper contracts rely on physical liquidity. When retail hoards, that logic crumbles. The $70 flash crash base, held because real money, family offices, industrials, pounced on the liquidation fire sale. Not weakness, but absorption. The system's attempt to suppress backfired, reinforcing upward gravity toward Shanghai's $83 reality, as 819 tons dwindle further in January with exports banned. A $100 squeeze isn't speculative. It's probabilistic, rooted in math of deficits and depletions. If you've modeled these deficits or tracked solar EV uptake, how do you see the inelasticity playing out? Drop your calculations or insights in the comments. Contrasting views could pinpoint where the model breaks. Black swan risks lurk, testing resilience. Technological substitution. At 70 to 80 stables, copper galvanics tempt solar firms, despite lower conductivity and oxidation issues. A breakthrough announcement from a giant like Samsung could implode prices structurally. Fed hawkishness, sticky inflation, halting cuts, or prompting hikes strengthens the dollar, headwinding commodities. Geopolitics as wildcard. Safe haven surges from tensions, but supply chain ruptures from conflict could eviscerate demand. Yet these don't negate the core fracture. Logistics strain. Western refineries, hooked on Chinese supply, face vacuum as flows halt. Military angles subtly tie in. Silvers and munitions, electronics for drones, radars, heightening strategic hoarding amid global frictions. History's 2008 commodity unwind showed how financial crises cascade, but silver rebounded on industrial revival. Today's deficit is deeper, less reversible without border reopenings. The process unfolds non-linearly. Symptoms like premiums and crashes precede full cause revelation. The ban, demand black holes, interlacing with past crises to highlight eroding sustainability. Where earlier systems self-corrected via arbitrage and output ramps, now sovereign controls and tech lock-ins accelerate divergence. For industry insiders in solar or EVs, is this premium reflecting your supply chain stresses? Write about your experiences in the comments. It adds ground-level data to the systemic view. Banking's 2026 war manifests in forecast spreads. A lack of consensus signaling lost grip on narratives. Retail's decoupling amplifies. 57% triple-digit bets mean holdings stay off-market, starving paper settlements. Institutions miss this. Their models assume elastic supply, ignoring the East's inward turn. As we approach the ban, watch SHFE drawdowns. If 819 tons halves in weeks, backwardation intensifies, pulling global prices east. This isn't rally end, it's phase shift, where physical trumps paper and scarcity dictates terms. If you're following geopolitical resource plays, how does Beijing's lockdown compare to past commodity controls in your eyes? Share your parallels in the comments. It could illuminate the broader shift. The silence from Western media on this Eastern curtain drop? Another anomaly, focusing on COMEX volatility while ignoring the supply fracture. This omission erodes trust, as if acknowledging the premium would admit controls lapse. Ultimately, the system's losing equilibrium at the intersection of industrial inelasticity and geopolitical barriers. The $8 gap isn't closing, it's widening, forecasting a $100 floor as deficits compound. We've crossed into a regime where traditional mechanics, margins, arbitrages, fail against sovereign hordes and tech demands. For retail investors who've bought dips, does the $70 hold feel like a floor or a trap? Explain your stance in the comments based on what you're seeing. It contributes to mapping this unfolding reality. This fracture's in motion, embedding silver deeper into strategic choke points with no quick reversal. The market is known, fluid, arbitraged, balanced, fades, yielding to segmented realities where access dictates value. We're in the early depletion phase, inventory signaling the tipping point ahead. The fracture isn't theoretical anymore. As of this hour, December 30th, 2025, the Shanghai Futures Exchange has already registered another 47-ton withdrawal from registered warehouses in the final trading session before the holiday cutoff. That brings visible stocks down to roughly 772 tons, assuming no unreported deliveries overnight. In 4 days, we lose access to the single largest refined silver refining base on the planet, and the visible inventory is evaporating at a rate that would exhaust the remaining metal in under 4 months at current withdrawal velocity. This is not a slow bleed. This is surgical removal of buffer stock right before the supply valve is welded shut. Western participants keep treating the $70.25 print as capitulation. They shouldn't. That level was defended not by stubborn retail, but by physical buyers who treated the forced paper dump as a fire sale. Delivery notices on COMEX for January contracts are already climbing faster than December's equivalent period in 2024, up 38% week over week, according to the latest standing data. Someone is standing for delivery in size, and they are not doing it to flip futures. They are doing it because they do not trust the chain of custody past January 1st. When you see standing for delivery spike while paper prices being actively suppressed, the message is unambiguous. Control of the physical is shifting away from the paper market's traditional custodians. This is the exact inversion of the 2021 retail squeeze attempt. Back then, crowds tried to force a short squeeze through coordinated buying of paper and calls. The system responded with margin escalations, position limits, and delivery delays until the pressure vented. This time, the squeeze originates from the supply side, executed by a state actor with no interest in profit maximization and every incentive to prioritize domestic continuity. Beijing is not shorting futures to profit from a crash. It is long physical metal by default, because it controls the refining and now the export flow. The asymmetry is extreme. One side can print unlimited paper obligations. The other side can simply stop signing export licenses. History shows which side eventually prevails when physical access becomes the binding constraint. Look at the precedent of rare earth elements in 2010 to 2011. China announced export quotas that slashed global availability by 40% overnight. Western prices for certain oxides jumped 500 to 900% in months because downstream industries, magnets, phosphors, catalysts, had no immediate substitutes and stockpiles measured in weeks, not years. Silver is tracking a similar trajectory, but the end use is far more pervasive. Rare earths were niche. Silver is embedded in every layer of the energy transition and digital infrastructure. Solar alone consumed an estimated 165 million ounces in 2025, roughly 19% of total mine supply plus recycling. Add EVs at 25 to 30 million ounces projected for 2026 and accelerating, plus AI data center electronics at another 15 to 20 million ounces annually by 2027. And you have a demand floor that mining cannot match in the short to medium term, even if every Western mine ran at 110% capacity tomorrow. New mine supply responds with a 5 to 10 year lag. Existing primary silver mines are already at peak output in most jurisdictions. Byproduct silver from copper, lead, zinc operations is tied to those base metal cycles, which are softening in a high-rate environment. Recycling, the supposed shock absorber, has plateaued. Above-ground stocks are finite, and high prices do increase return flows, but not enough to close a structural deficit that has averaged 180 to 220 million ounces annually since 2021. The math does not bend. Annual mine production plus scrap recovery approximately 1.05 billion ounces. Annual demand approximately 1.25 to 1.28 billion ounces in 2025 to 2026 projections. The gap is being filled by inventory drawdown. First exchange, then private, then strategic. China is accelerating that drawdown by fiat. If you have visibility into COMEX or LBMA eligible/registered inventories over the past month, what trend are you seeing in the rate of warrant withdrawals versus new deposits? Drop the numbers or the pattern you observe in the comments. It would help calibrate how quickly the Western buffer is following the Eastern one into depletion. Backwardation on the SHFE is not flirting with extremes. It is entrenched. December spot has consistently traded 400 to 800 won per kilogram above the near-month future for the last 10 sessions. That spread equates to an annualized convenience yield north of 25% when you factor storage and financing costs. Industrial consumers are paying that premium, not because they are irrational, but because halting a solar stringer line or an EV battery pack line costs far more than any reasonable silver price. A single gigafactory idled for a week due to paste shortages burns 9-figure revenue. The calculus is brutal and unforgiving. They will bid up spot until marginal supply appears, or until substitution becomes viable. And substitution at scale is years away, not quarters. Western banks understand this at the operational level, even if their public research desks downplay it. The margin escalations were not about prudential risk management. They were about buying time. By liquidating leveraged retail and small speculative positions, the system cleared out the noisiest cohort before the real stress test arrives in January. The quiet absorption at $70 to $72 tells you who benefited. Large commercials with physical books, proprietary trading desks with deep pockets, and industrial hedgers who needed to cover forward requirements. They did not panic sell into the waterfall. They accumulated. This creates a dangerous asymmetry for anyone still positioned only in paper. When the premium persists past the new year and delivery pressure mounts on COMEX, the next margin hike, or position limit adjustment, will face a different market. The weak hands have already been shaken out. What remains are parties that can afford to take delivery or roll at punitive cost. If standing for delivery continues to accelerate, the exchange will either raise margins again, further squeezing liquidity, or allow forced cash settlement at a price that may no longer reflect physical reality. Either path accelerates the perception that paper is decoupled from metal. Once that perception hardens, trust in the pricing mechanism erodes, and participants migrate toward physical or offshore venues. That migration has already begun in small but measurable volumes. Retail and family office purchases of allocated bars and coins spiked 47% week over week in the US and Europe following the flash crash, per dealer reports. For those of you running physical accumulation programs or working with vaulted metal, are you seeing allocation delays, higher premiums on 1,000-ounce bars, or tighter spreads between wholesale and retail right now? Share what you're experiencing on the ground. Those operational frictions are leading indicators that rarely make headlines until it's too late. The institutional forecast schism is widening into something more fundamental than differing economic assumptions. Goldman and Citi are pricing in persistent scarcity and inelastic demand. JP Morgan and Commerzbank are pricing in mean reversion via macro slowdown or substitution. But substitution timelines are lengthening. Early laboratory work on copper-based conductive paste shows 10 to 15% efficiency losses in next-gen heterojunction cells, and oxidation remains a multi-year reliability issue. Scaling that to terawatt annual production without massive field failure risk is not a 2026 story. It is a 2030-plus story at best. In the interim, silver remains non-substitutable at the margin. The banks betting against scarcity are therefore betting on a technological leap that has not yet materialized, or on a demand destruction event large enough to offset the structural deficit. Neither looks imminent. Geopolitical layering adds torque. Export controls on critical minerals are no longer hypothetical. The US has already restricted gallium, germanium, and antimony exports from China. China has retaliated symmetrically. Silver is not yet on either explicit list, but the licensing regime announced December 30th functions as de facto control without naming it as such. If tensions escalate, Taiwan, South China Sea, semiconductor choke points, the probability of formal silver export restrictions rises sharply. At that moment, the $8 premium becomes $20 or $30 overnight, and backwardation goes vertical. The system has no buffer left to absorb that shock. We are therefore not watching a correction within an uptrend. We are watching the transition between market regimes. The old regime assumed global arbitrage, elastic supply response, and paper dominance. The new regime is segmented. Physical metal trades to its highest value, most urgent use case. Paper trades to the lowest common denominator of leverage speculation and hedging. The two prices will diverge until one forces reconciliation. Either massive Western demand destruction, unlikely given policy imperatives around green and digital transitions, or Eastern supply relaxation, unlikely given strategic autonomy, priorities. The process is already in its second phase. Phase 1 was inventory drawdown and premium emergence. Phase 2 is regulatory containment failure in the West, coinciding with supply lockdown in the East. Phase 3, when backwardation spreads to London and New York, when delivery queues lengthen, when substitution talk gives way to allocation rationing, begins in weeks, not years. If you have followed previous commodity regime shifts, nickel 2022, uranium 2023 to 2024, lithium 2021 to 2023. What early markers do you recognize here that match those transitions? Write your observations in the comments. Patterns from other metals can help us anticipate the velocity of what comes next. The final signal is the silence. No emergency commentary from the CFTC on the margin sequence. No urgent briefings from the LBMA on cross-border flow risks. No mainstream headlines screaming about the largest refined silver jurisdiction closing its export window. That absence is not oversight. It is containment. Acknowledging the fracture publicly would accelerate the very migration away from paper that the system is trying to delay. So the fracture proceeds in low volume, in after-hours data, in dealer back channels, in warehouse receipts that no longer refill. Silver is no longer just an industrial metal or a monetary metal. It has become a litmus test for whether global commodity pricing can still function under fragmented sovereignty and inelastic strategic demand. The answer emerging in real time is no, not in the old form. The market will find a new equilibrium, but it will do so through price levels and delivery mechanisms that render much of the existing paper superstructure obsolete. We are crossing that threshold now. The $83.35 in Shanghai is not an outlier. It is the leading edge of where equilibrium reasserts itself when physical control finally overrides paper control. Everything else is noise until that reassertion completes. And it is completing faster than the models anticipated.